Welcome to Exchange Traded Fridays, brought to you by ETF.com. I'm your host, Sumit Roy, Senior Analyst here at ETF.com. This week, we saw a monumental shift in the ETF industry. The Spider S&P 500 ETF, popularly known as SPY, is no longer the world's largest exchange-traded fund. It's been surpassed by none other than the Vanguard S&P 500 ETF, VOO. Here at ETF.com, we've been writing about the potential for SPY to be eclipsed for a very long time. But now that it's actually happened, it doesn't make it any less shocking. We have a lot to say about this enormous milestone. After that, we'll be discussing ETFs for the long term. I know Valentine's Day was last week, but we're still in a loving mood here at ETF.com. So we'll be breaking down some of the funds we'd love to have in our portfolios for the long haul. You don't want to miss that. And finally, special guest Sean O'Hara, president of Pacer ETF Distributors, is going to join the pod to talk about risk management and his firm's trend following ETF, PTLC. So without further ado, let's get into it. On today's show are myself and my fantastic colleague, senior content lead Kent Tooney, contributing editor Ron Day, and reporter DJ Shaw. Great to be here with you guys.
Hey, Sumit.
Great to be here.
Hello.
So, Ron, I was out of the office the day that SPY lost its ETF crown to VOO, but you were there. What was the mood like when that happened?
Well, Sumit, we had been planning for this, as you just mentioned on your intro, for I guess it was like even about a year ago. We noticed the gap was narrowing between VOO and SPY, and it really seemed like it wouldn't be long before one eclipsed the other. So we had been planning very diligently and had written up templates and had stories ready to launch. And then, became kind of this anticipation and waiting game thing. Like, when is it going to happen? When is it going to happen? Almost like when the spot Bitcoin ETFs were approved. You're just kind of waiting, bated breath, ready to jump when the story when you got the final data. So, we had all these stories ready to go, and it was kind of a coordinated effort to make sure, you want to kind of throw the news out real fast, but you also, as reporters, we have to make sure everything's accurate, make sure it's right, and recheck our data. And so it's a mix of excitement and caution, being careful, doing
Right.
your due diligence. Overall, though, it's kind of like the dam broke, and everybody was kind of excited and ready to kind of reevaluate the standings. It's because it's a new era. It's definitely it's a new time. A lot of our stories are have a different blush now, with a different fund at the top of the heap. And I know DJ had some thoughts on kind of like what this means now for the industry.
Yeah, so Tuesday was when all of this officially happened. VOO overtook SPY as the long reigning world's largest ETF by assets under management. So far over the last year, VOO has pulled in about $125 billion in inflows, while SPY has just taken in about 34 billion. SPY has seen a lot more days of net outflows than inflows over the past year as well. But this kind of marked a shift, I would say, in passive investing, with investors increasingly more leaning more towards the lower fees, but SPY still has an edge in liquidity and trading volume. So this has kind of been SPY has been more of a go-to choice for institutional investors and options traders. One thing that I did find interesting while I was writing this story was that this wasn't the first time that SPY was actually overtaken as the largest ETF by AUM. The GLD gold ETF also overtook SPY. I think it was back in 2008. So that was an interesting little tidbit of
Great
information
point.
I
Great point,
dug
DJ.
up.
That's very interesting piece of history there. Yeah, that was yeah, these were much smaller ETF. SPY was a much smaller ETF when that happened. I forgot how much
And
was in it.
Sumi,
Maybe
doesn't
like
it look
70
like
billion.
today, like it's flipped back? I mean, this is, the league tables change. Or not
Yeah,
league
Exactly.
I
tables, but
was
the biggest, it looks like it may have flipped back maybe temporarily, most
It
likely
has actually.
temporarily.
It has
Yeah.
actually, Ron. I'm looking at it right now, and it's looking like SPY is once again the world's biggest ETF. $636.7 billion in assets under management, which is a billion more than VOO. So we're probably going to see this flip back and forth until maybe at some point VOO just gets so far ahead of SPY that never flips back again.
and I just
What do you
want
think?
to add a
Can I
quick
ask you what you think
correction.
might have happened over the past 24 hours or whatever to change things, like anything in the market?
It's a down market. I mean, that was
Yeah.
my observation. I mean, there's a high correlation between an upward trend and VOO climbing in assets. And like to DJ's point, institutional traders and looking for liquidity options, everything. Maybe they're less afraid of buying when the market's down, and maybe the retail investors that are long-term VOO, maybe they start to get a little bit nervous when the market falls. But I've noticed that SPY tends to pick up or can gain on a down day, whereas VOO tends to lose assets.
Really quick, I just want to add a quick correction. I said 2008 earlier, but it was 2011 when the SPDR Gold Trust overtook SPY. At the time, GLD had $76.7 billion in assets compared to SPY's $74.4 billion.
Wow. Yeah.
74 billion seems like such a small number now.
Yeah. Right. SPY is almost 10 times bigger now.
I
So
mean,
that,
when are they gonna be a trillion? I mean, that's gonna be the next story. Ron's already tracking when it's gonna cross a trillion, we're gonna get a story ready.
yeah.
You bet. I mean, it could be
Ron has already
soon.
written up the template for that.
Well, it's interesting. I think I saw some statistic like the top three. I think it was the top, and maybe somebody else saw this too, but it was like the top three ETFs account for like 17% of all the AUM or something, which was, I mean, I guess it's like several trillions, just the top three, or almost like a
Yeah.
trillion and a
Yeah.
half, you know? It's probably
The
not that
top three
long.
have 600 billion or more each, Ron. So you're right.
Yeah.
There's about a 1.8 trillion, 1.9 trillion in those three funds,
So that's
which is,
close to $2 trillion in three funds. It's a $10 trillion market. I
yeah.
mean,
ETFs, yeah. I mean, it's been a top heavy industry, and it continues to be a top heavy industry. We've been starting to see, the base widening out a little bit, with the popularity of active ETFs growing, things like that. But even with all that, these juggernauts at the top continue to, really dominate and take the lion's share of the flows that are coming in. So yeah, now Vanguard S&P 500 ETF is the top dog. SPY is number two. But Ken, interestingly, you wrote a piece recently talking about how SPY slipping from one to two might not be the end of SPY slide down the leaderboard. It could drop even further. Isn't that right?
Correct. Yeah, I think you briefly mentioned at the beginning of the call, iShares Core S&P 500 ETF, the IVV, is closing the gap. According to our own ETF.com data, IVV pulled in 86.7 billion of assets in 2024 compared to 16.5 billion for SPY. So that's a pretty wide gap right there. I mean, if that pace continues, then IVV could surpass SPY as the second largest ETF this year. And I think you were also kind of taking a look at, hey, maybe even IBIT would surpass it. Didn't you say that could happen in the
Yeah,
next?
that was kind of my dark horse prediction. It basically, IBIT is around, I don't know, 55, $60 billion. And of course, it's broken a ton of records on the way there. Fastest ETF to, it got there in basically a year to $60 billion in assets. Now, obviously, has a long way to get to where SPY is at over 600 billion. But if we assume that Bitcoin ETFs continue to take market share in the Bitcoin market. They become a preferred way for people to invest in Bitcoin. I can see that becoming a multi-$100 billion ETF, and it can continue to climb. And maybe it might not reach the level of SPY, but it can be a top 5 ETF down the line. So yeah, that's my kind of wild prediction. Maybe one day it could surpass SPY, but definitely top 5. I can see that happening.
Right. Yeah. Especially if the market continues or helps it out. In other words, so, crypto continues to gain in popularity. Maybe even we see a recession.
Yeah.
So then you have investors chasing after performance, and that definitely plays into it.
Yeah, yeah. But man, it's been a crazy year in terms of how quickly VOO made that final jump to surpass SPY. And a lot of it has to do with just how horrible of a year it's been for SPY in terms of flows. It's had outflows of over $18 billion just in the first several weeks of this year. And that is in sharp contrast to VOO, which has picked up $24 billion of inflow. So you're talking about a gap of almost $45 billion between those two ETFs. IVV, we've talked about, Ken just talked about that and how it might surpass SPY. That has seen outflows of $1.8 billion this year. So much less than SPY in terms of outflows, but lagging well behind VOO, which is just on a whole nother world, it seems, with these inflows we're seeing this year. So clearly investors are making it clear that VOO is the preferred way to get access to the US stock market. And I don't really see that changing. Do you see that changing, Ken? Given Vanguard's reputation, its low fees, I don't see anything surpassing VOO anytime soon.
I don't think so either. And I think the VOO is kind of follows along the story of exchange traded funds. I mean, it's opened up more and more and more to retail investors. I mean, I've been an investment advisor since before ETFs even came out. But I've noticed that at first they were really kind of institutional, professional traders were using them, and it's increasingly now retail investors, and they love the low fees, and that's what it's all about. So I see VOO continue to dominate for that reason.
Absolutely. So, I think that's a good segue to our next segment. Kent, Valentine's Day was a week ago, but you wrote this really interesting piece related to the holiday that we didn't get to discuss on our episode from last week, but I want to talk about it now. And it's titled The 7 Best ETFs to Love for the Long Term. VOO was one of the ETFs you mentioned, but you had 6 others in there as well. I thought it'd be fun if you could go through those, and then Ron, DJ, and myself could throw out a few other ETFs that we love as well.
Sure. Yeah, you mentioned VOO. I also mentioned, another top 5 ETF as far as assets under management, QQQ. Quick side note that my favorite long-term investor is my oldest son, and we talked about ETFs to buy for the long term, and he's got a Roth IRA, and so we put 100% of it right there in QQQ. I mean, it's a great buy and hold long term. You've got access to technology, health, and the big tech players that will continue to dominate over the next decade, probably. SCHD, very popular fund, Schwab US Dividend Equity ETF. It just has that combination of growth and income, appeals to a lot of investors. SMH, the VanEck Semiconductor ETF. They've been the hottest sector or subsector, if you will, over the last decade, and I wouldn't be surprised if they will be over the next decade. XBI, this was kind of an outlier, biotech ETF, a combination of healthcare and also it's an indirect artificial intelligence play. I wouldn't be surprised if we see cures for cancer, even hopefully, but things like that can be developed rapidly over the next decade. And then BND is just a solid, large, this Vanguard Total Bond Market ETF. Bonds are not really popular right now, but they're important diversification tools. And then VXUS, Vanguard Total International Stock ETF. another diversification tool. Yeah, actually, some of the international stocks are outperforming U.S. stocks this year. So it just reminds us of important to have how why it's important to have exposure overseas. And that's it for there were seven of them.
Yeah, yeah. Really cool list there, Kent. You got some nice low cost broad ETFs in there like VOO and BND and even QQQ. And then you have some more speculative ETFs, but that might have, nice upside like XBI in there and SMH. Yeah, nice mix you got there.
All right, thanks. What do you
Yes.
have? You have a favorite?
I do have a favorite. I mean, it's not that exciting, but maybe it is. I don't know. But GLDM, right? The gold ETF. We talked about GLD earlier, how it was briefly the world's biggest ETF. But there now is a cheaper version of that fund on the market, GLDM, that offers the same exposure to physical gold. And as a lot of people listening might know, gold prices have been just on a tear recently, hitting record high after record high. They're now around 2950 on their way to 3000, one of the best performing assets of this year. I'm not necessarily saying, oh, it's a great time to buy gold right now. I mean, it's hard to time any market, let alone the gold market. But gold has, I think, proven to be a valuable asset to hold in a portfolio. It offers, diversification benefits. It's not really correlated to any other asset or asset class. And it tends to do well during times of uncertainty. We've seen a lot of these other markets kind of pull back, when we got all this word about tariffs and the deep seek fears, but gold has rallied. And, I think it's worth considering in a portfolio. It's not for everyone. But if you do want gold in your portfolio, GLDM is a great way to get that exposure. Very low expense ratio, and offers, straightforward access to a really nice asset. So yeah, not super exciting, but I think this is definitely a fundamental building block that people can use in their portfolios. How about you, DJ? What ETF do you love for the long term?
So I'm glad I'm going first. I hope I didn't pick the same one Ron did, but my pick was ESPO, the Van Eck Video Gaming and Esports.
Interesting.
I never even heard of it. So you're
I
safe.
just I just enjoy this ETF a lot. I usually pick it as my favorite on, any list that I'm doing, just because it's an interesting choice. It's outperformed the S&P 500. It's up 57% over the past year. And it's just, all around just interesting because I'm a big gamer and, gaming is a multi-billion dollar industry that is just, continuing to grow, especially with advancements in chips and technology. I know NVIDIA just released a 50 series GPU. So, a lot of advancements in tech, and this ETF holds companies like Activision, Blizzard, and NVIDIA as well. So these are all big growing companies.
I noticed
Right.
it also has AppLovin as the top holding, and that stock has just been on an absolute tear recently. And kind of an advertising technology company that's been using AI, stock is up an insane amount, and that's definitely helped this ETF recently.
Yeah, I was going to say, DJ, that's an interesting point because I mean, well, we need to listen to your generation because you are the future. But a lot of investors don't realize, or maybe just haven't thought about it, but that was a huge part of NVIDIA's growth was the gaming industry and how their chips drive because those PC games require a lot of processing.
Absolutely. Yeah, great point. Before Nvidia was this AI juggernaut, it was its biggest revenue segment was, from those graphics cards used for video games. And it continues to be a multi-billion dollar segment for the company, but obviously overshadowed by the sales of its AI chips. But yeah, really cool ETF there, DJ. Ron, how about you?
Well, I'm going to go a bit contrary. I don't like really drilling down into things. I like to kind of put my money somewhere and just kind of leave it alone. Um, so when I first started putting money into a 401k in whatever it was, like the 90s, I tried to divide it between large, small, and mid caps, or small, mid, large, and so that was a long time ago. So I'm a fan of like small caps for the long term. So I was looking at VB, which hasn't been great. Everybody knows small caps have been. I mean, they're not losing money over the past few years. They're not great. They're not. I
Yeah.
mean, VOO is beating it pretty handily. Um, I do think again, I don't drill down real specifically. I'm not an FA. I don't, but I do like if you're thinking broadly, as I think most people do. I mean, we're not all specialists. You think about exposure, broad exposure. So I liked having that kind of risk of the small caps in uh,
Yeah.
in my portfolio. So and
Yeah.
it's been good over multiple decades.
Right. It hasn't gone down. It's been going up, but it's been underperforming the
Yeah.
large cap ETFs, like you said, Ron. And of course, a lot of people think that's eventually going to shift. We're going to see the large cap
Yeah.
segment eventually underperform, maybe if the Mag 7 start to buckle a little bit. We'll see if that happens, but regardless, VB is a great choice there in the small cap segment. All right, so I think that's a great place to shift over to our next and final segment. I'd now like to introduce a very special guest, Sean O'Hara, president of Pacer ETF Distributors, who's going to speak with me about risk management in the current market environment. Sean, great to have you on the show.
Oh, thanks for having me. It's always nice to be with you.
Absolutely. So, Sean, there's been no shortage of scary headlines this year, from Chinese AI related worries to tariffs. Investors have had a lot to deal with during the first several weeks of the year. But even though that's been the case, we've seen the stock market continue to hover near record highs. How do you reconcile this situation? Is this another instance of the market climbing a wall of worry?
Well, I mean, historically, that's been the case, right? I think what's going on, currently is there's like, two sort of competing narratives, if you will. You have, this optimism around a new administration that, seems to be, pro-growth, pro-market, pro-America. And the other narrative is that, the tariffs and the Fed and all of these potentially, you know, negative things could affect the market. But, the market's been pretty resilient here. I think, some of it probably has to do with, we used to say several years ago, the old TINA idea, there is no alternative. And that was, people had to buy stocks because there was no yield in bonds. I think there's a similar story going on here, which is that, given the choice, I think most people would choose to invest here in the United States as opposed to abroad. And so I think that's sort of buoying the stock market a little bit. And I think people are optimistic that, we're going to continue to see, good earnings reports and good earnings growth. So with all that being said, one of the things that is somewhat troubling to me is that we are trading at fairly high historical levels with regard to the overall market's PE. And I think, investors are starting to pay attention to that a little bit. So it's been interesting, as you said, and, it's been a great start to the year for sure. And so hopefully things can continue.
Yeah, absolutely. A lot of cross currents, right? You talked about the pro business, maybe even tax cuts coming down the line. And then on the other hand, there's the tariffs. How should investors think about risk management in this type of environment?
Well, I mean, I think when you get to these elevated levels, having a little part of your portfolio sort of earmarked towards risk mitigation management certainly makes sense, particularly for older investors. For young guys like maybe not so much me. I'm more the older crowd, but if you have a lot of time left to work and continue to contribute, maybe you are a little bit less concerned about that. But if you get into those near retirement or into retirement years, then these big drawdowns can have a really big impact on people.
Yeah, and speaking of risk mitigation, Sean, you have an ETF that fits perfectly with everything that we've been talking about. It's called the Pacer Trend Pilot US Large Cap ETF, ticker symbol PTLC. It's a trend following ETF that adjusts its holdings based on how the stock market is doing. Can you tell us about it?
Yeah, I mean, I like to refer to it, as the S&P 500 for baby boomers. The 200-day moving average is a technical indicator that's been used for decades, sort of as entry and exit points, if you will. What Trend Pilot does, PTLC does, is it sort of takes advantage of that 200-day simple moving average. And it has a couple of really simple rules. If the index it's tracking, in the case of PTLC, it's the S&P 500. If that's above its 200-day moving average for 5 consecutive days, then we're going to own the index. So it's just like owning an ETF that owns the S&P 500, like IVV or SPY or something like that. However, if the index falls below its 200-day moving average for 5 consecutive days, the portfolio will move to 50% T-bills and 50% the S&P 500. The idea being that, when the market falls below that 200-day moving average, it tends to be a negative trend. And so we'll be in that 50-50 mode, which is sort of a, wait and see, somewhat of a protectionist mode. From there, really only two things can happen. Either the index will go back above its moving average, which means it's not really a long-term trend change. We'll go back into the S&P 500, or the moving average itself sort of trails the market. So if the market goes down, eventually the moving average will start to arc over and go down. And if during that 50-50 period, we see the 200-day moving average start to decline, the rest of the portfolio will go to T-bills, and then we'll wait until the market goes back above its 200-day moving average. And so, the last 3 years is a great example for how a strategy like this might work. The last 3 years, PTLC is beating the S&P 500 on a total return basis, mostly driven by the fact that in 2023, the stock market went down quite a bit, but PTLC, because of the 200-day moving average, moved to T-bills and protected the assets on the downside. The simplest way to think of it, really, Sumita, is just think of it like a traffic light. You have red, yellow, and green. Well, green means go. That's when the index is above its moving average. Yellow means slow down. That's when the index falls below its moving average. And red means stop, and that's when the 200-day, the actual moving average goes negative. And so we operated on a very simple basis, and these rules have been, followed for quite some time. And for those who want to participate in the upside, but also to manage some of their risk to the downside and don't want to follow the market all the way down to the bottom if we have a bear market scenario, PTLC can be a pretty useful part of that portfolio.
Really interesting ETF, Sean. Do you have any rules of thumb for how this type of fund will perform compared to, say, a broad market S&P 500 ETF, typical like a VOO or something like that? I know, say, the stock market dropped 50% like we saw during the financial crisis. This is obviously going to outperform dramatically. On the
Yes.
other hand, if the market shoots to the sky, maybe it will or won't. I don't know. Do you have any rules of
Well,
thumb? How?
I mean, just think about the last couple of years, like 2024, we were up basically exactly what the S&P was. 2023, we were down roughly half of what the S&P was down. So, when you have some big directional changes, we're 100% in the S&P today, so we're getting all the return. And so in a, big up market, we should do, fine and track the index like we're supposed to. In a big down market, we think we'll mitigate some of the risk to the downside. We do go through periods where you have some choppiness in the market, and you can get some false signals out of this trend pilot, the 200-day moving average. And so you may give up some return in a choppy market, but generally speaking, over long cycles, I think what you would expect is that you would perform similarly or maybe better than the overall market through a full market cycle. That meaning a bull market and a bear market kind of smashed together. We'll do fine in the bull market. We'll do much better in the bear market using a strategy like this.
And Sean, you mentioned it's kind of S&P 500 for baby boomers. Do you say that because it avoids those massive drawdowns? And obviously, if you're close to retirement or in retirement, you really do not want to go through those.
Yeah, I mean, if you're peeling off income from your portfolio, let's say you're retired, what really can disrupt your plan more than anything is to take money out in a down cycle. And so by moving to the sideline in a big down cycle, it preserves capital. And so that's why I think of it like the S&P 500 for baby boomers. If you think about baby boomers and what they want decent returns over time. They're not overly greedy, it seems. They don't want, skyrocketing returns. They just want competitive returns that can keep up and beat inflation. But what they don't want is they don't want to see their life savings, if you will, go down 25 or 30 or 40 or 50% in a bear market cycle.
Right, right. And I'm looking at the assets under management in this ETF. They're currently at record highs, actually, $3.6 billion in assets under management. But I noticed that in 2019, there was a huge surge of demand for this ETF. Then in 2020 through 2022, it kind of leveled off, and now it's picking up again. Do you know why that's the case? Why is demand suddenly taking off now?
I think, so 2020 was a very difficult cycle for a trend following strategy. If you think back to when we announced COVID and we closed the world down, the stock market fell like 35% in the course of a month. That big decline in that environment, Trend Pilot was down about half of that, about 18%. But then the market slowly recovered as we saw all sort of adjusted. But because the 200-day moving average moves a little slow, it took a little bit to late in the year before we re-engaged. And I think people misunderstood what it was supposed to do. And I think going into this year and towards the end of last year, I think people are starting to think, this market's highly concentrated. A lot of the weight in these broad indexes is in a small number of names, and most of the performance is being contributed by those names. And having something that is different that could help us manage the risk to the downside might make sense for a part of the portfolio. We never really talk about, telling somebody to take all their money and put it in PTLC, for example. But we say if you have a sizable S&P 500 position or you own VOO or something like that, broad market ETF, then, putting this in for like, 20 to 30% of the money gives you that position that will help mitigate the risk to the downside. And I think that's what's happening today.
Yeah. And I do wonder if now that T-bills are yielding something substantial, right, 4 or 5%, it makes this type of ETF a little more appealing versus, 5-6 years ago when T-bills were yielding nothing. Now, even if it switches into T-bills, it's not necessarily a bad return, right?
No, it's not. It's a short-term treasury return, and you hit on something important. 10 years ago or 7 years ago, when interest rates were next to zero, the value of that defensive position was that you wouldn't go down anymore, but you weren't really going up. With T-bills now yielding something, when you're in that defensive position, you're not giving up all your return. You're getting some return on your short-term cash, which is somewhat attractive at 4 to 5% today.
Fantastic. Well, I think that's a great place to leave it. Sean, it's been an absolute pleasure having you on the show. Thanks so much for your time.
Thank you. I always appreciate it.
I want to thank all our listeners for tuning in to Exchange Traded Fridays. Remember, if you haven't already, subscribe and follow us wherever you get your podcasts. And if you have a question or you want to share your thoughts, join the conversation with us on X. Our handle there is ETFCOM. Catch you next week.